The correlation between Bitcoin and gold has been almost non-existent over Bitcoin's life, 0.14. It is not only a risk-on asset, thanks to the new technology, but it is also a risk-off asset. It's a hedge against inflation. We do think it will be a very important store of value going forward, particularly as we go through the intergenerational wealth transfer that we expect during the next 5, 10, 15 years.
Cathie Wood begins by addressing one of the most controversial moments in Bitcoin this year, the sharp drawdown following the October 10th flash crash. According to Wood, this wasn't a fundamental failure of Bitcoin. Instead, it was largely the result of automated deleveraging, likely triggered by a software glitch at a major exchange. That event unleashed roughly $28 billion in forced liquidations, creating what she describes as carnage across the crypto market. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support.
The Bitcoin realm, it's been controversial this year because we had the drawdown after the flash crash, 1010, in October. We think that a lot of the deleveraging associated with, really, that was a software glitch, I think at Binance, that deleveraging, automated deleveraging, caused $28 billion of carnage. We think we've worked through that now. And I think the main question on Bitcoiners' minds is, okay, are we finished with the traditional 4-year downdraft? Every 4 years, a downdraft in the cycle. We're beginning to think we are, although we could base here in the $80,000 to $90,000 range for a while. But we do believe the next inflection is up. And while I know we got a lot of publicity this year because we talked about stablecoins usurping one of the roles we expected Bitcoin to play. Now, we expected this 10 years ago before stablecoins happened on the scene. But in terms of remittances and emerging market activity, we're seeing stablecoins usurp that role that we thought Bitcoin would provide. That doesn't take away, though, from what we think ultimately will happen to Bitcoin. Bitcoin's role as digital gold has miles to go. Interestingly, and you'll see this in my New Year letter, the correlation between Bitcoin and gold has been almost non-existent over Bitcoin's life, 0.14. Nonetheless, we do think it is not only a risk-on asset, thanks to the new technology, but it is also a risk-off asset. It's a hedge against inflation. Its growth rate is lower than gold's growth rate, and I'll bet gold miners are doing their darndest to get more of that stuff out of the ground now that they're being paid so much more. That can't happen with Bitcoin. And Bitcoin miners, mathematically metered to top out at 21 million units. So we do think it will be a very important store of value going forward, particularly as we go through the intergenerational wealth transfer that we expect during the next 5, 10, 15 years. We also had a lot more on DeFi and tokenized assets. Stablecoins, just a little bit more on that. I think we passed $300 billion globally in stablecoins. We saw a very large increase in tokenization on public blockchains, up to 19 billion. Now, that's a large increase. I think that was a tripling or maybe even more in the last year. But we ultimately think that's going to 11 trillion, highlighted by public equities, sovereign debt, and bank deposits. So it's going to be a very big market. And we are putting out a DeFi quarterly now to accompany our Bitcoin quarterly.
Cathie Wood then pivots to gold, placing today's price action in a long historical context. She notes that gold relative to global money supply, M2, has only been higher once in the past century, during the Great Depression, when money supply collapsed by roughly 30% and gold prices were fixed. The last comparable peak occurred in the early 1980s, driven by double-digit inflation. Today's environment is different.
To M2, going back to the 1920s, gold relative to M2 has been higher only once in history, in that more than or roughly 100-year history. And that was during the Great Depression, when the gold price was fixed at $20.67. But money growth collapsed by 30%. Now, certainly we are not in that situation today. This is different. The last peak was in the early 80s, and we have just surpassed that peak. That peak was all about double-digit inflation and gold being one of the best hedges. We're not there either. I think what's going on is we are climbing a wall of worry. There's a barbell strategy out there, it seems, where investors, if they're moving into the equity market, they'll balance it out with gold. And or if they're moving into the bond market, balance with gold, especially given the geopolitical situation. We realize around the world that President Trump's behavior, and certainly what he's proposing about Greenland, what has happened in Venezuela, and so forth, that is causing great concern. And so gold is a refuge, and we think that's an important part of what's going on, as well as central banks diversifying into gold and maybe away from U.S. Treasury bills and the dollar. We believe that gold is overextended if you take a look at that chart. And if you look at what happened to gold in the 80s, when we were in Reaganomics, which we believe today is not just an echo of Reaganomics, but perhaps Reaganomics turbocharged with deregulation, tax cuts, the tariffs are passing through, and we're going to get rid of that source of inflation and that tax, we believe, as it washes through the system. So we are also looking at what we believe will turn into peace through strength, the defense buildup around the world. It's not just the U.S. anymore. And so we think that we're going to move into a bigger productivity boom, and that the return on investment in the United States is going to increase relative to that in the rest of the world. In the 80s, that drove the dollar up. It went up almost twofold in a very short period of time. So we would not be surprised to see the dollar go up. And, gold is priced in dollars. We think that will take the gold price down. These companies, their productivity, the companies that are emerging, their productivity is astonishing. Tether, for example, last year, we believe, delivered $50 million per employee. That is unheard of. But we think that the capitalizing on all of these new technologies is going to drive productivity gains much higher than people can even postulate right now. And with that, while many people are afraid, given the robotics movement of, and AI, everyone being thrown out of jobs, we disagree. We think this is going to be one of the greatest opportunities for the entrepreneurial spirit in history, especially because you can go to ChatGPT or Grok and say, I think there's a huge unmet need for this, that, or the other product or service. Think about it. And I would like to start that business. Boy, when we started ARK, I would have loved to have a starting point like that. And you can work with ChatGPT, XAI, Grok, to build your business. Try it. If you're looking for a job, figure out what's that unmet need. I'm going to try and start that business. And believe me, starting a business, very exciting, exhilarating actually, but full of risk. Remember, 90% of all startups fail. So just go in soberly that way. Make sure you're addressing a real unmet need, and then harness AI, harness blockchain technology, harness any of these new technologies. We're very focused on the deregulation, lower taxes, and what we believe will be lower inflation, much lower inflation, and lower interest rates in the U.S. And we think the combination of those is actually going to drive the returns on invested capital in the U.S. up relative to those in the rest of the world. And I think many people are underestimating, especially on the corporate tax side, that thanks to the new depreciation schedules, our effective corporate tax rate, not the statutory, but the effective, will drop to one of the lowest in the world at roughly 10%. Certainly near a record low for the U.S.
So do you think, Cathie, that's not priced in yet to U.S. equities? Like, have investors not realized that, and therefore it's not priced in yet?
You know, it's very interesting, the depreciation schedules, how massively they are going to encourage capital investment here in the United States. So we've never had full depreciation in year one of manufacturing facilities, full depreciation in the first year of service. That means corporations will get huge tax refunds that they will be able to reinvest into innovation, because we also equipment, domestic R&D, and software. Those three, full depreciation, first year of service, that has been legislated. Normally we get, a few years of this, this cut and that cut. But that has been legislated. Now it's all the time. So we don't think people understand how profound some of these tax changes are.
Cathie Wood closes with a powerful argument about U.S. competitiveness. She believes deregulation, lower inflation, and lower interest rates will raise returns on invested capital in the United States relative to the rest of the world. One of the most underappreciated changes, she argues, is in corporate tax depreciation schedules. For the first time, U.S. companies can fully depreciate manufacturing facilities, equipment, domestic R&D, and software in the first year of service, permanently, not temporarily.